Good afternoon, everyone. We are from Group 2, and today we are going to present about the types of dividend and payment method. Our group consists of Ahmad Al-Ghifari, which is myself, Marina Taniliandar, Putri Fani Yasmin, Aidil Akbar Shahreza, and Tiffany Regina Agita. So let's talk about the first subchapter, which is cash dividend and dividend payment. Let's talk about dividends and distribution. A dividend is a payment made out of firm earning to its owner in the form of either cash or stock. A distribution is a payment made by a firm to its owner from sources other than current or accumulated retained earning. So how do we differentiate dividends and distribution? We can differentiate it by if a payment is made from current or accumulated retained earning, it will be called dividend. Otherwise, it will be called distribution. However, it is acceptable to refer to a distribution from earning as a dividend and a distribution from capital as a liquidating dividend. Next, there are 4 types of cash dividends. The first one is regular cash dividends. A regular cash dividend is a cash payment made by a firm to its owner in the normal course of business, usually paid 4 times a year. As the name suggests, there are cash payments made to shareholders in the regular course of business, so management see nothing unusual about the dividend and no reason why it won't be continued. Second one is extra dividend. Sometimes firm will pay a regular cash dividend and extra dividend. The extra amount may or may not be repeatable in the future. So basically an extra cash dividend is just a dividend you pay alongside of regular cash dividend. Third is special dividend. Special dividend is similar to an extra dividend, but the dividend is viewed as a truly unusual or one-time event and won't be repeated. Lastly, we have liquidating dividend, which is the payment of a liquidating dividend usually means that some or all of the business has been liquidated or that is sold off. Liquidating dividend is different from other cash dividend payment because it doesn't reduce corporate cash or retained earning.
Hello, my name is Putri Fani Yasmin, and this is my part. I'm going to explain about the standard method of cash dividend payment. So when a dividend has been declared, it becomes a debt of the firm and cannot be resigned easily. So the amount of the cash dividend is expressed in terms of dollars per share, dividends per share, percentage of the market price or the dividend yield, or percentage of net income or earnings per share or the dividend payout.
Hello everyone, my name is Tiffany Regina Agita, and now I'm going to explain about the dividend payment chronology. So first, why I have to explain about the dividend payment chronology? Because when a company pays a dividend, there are a number of dates that are important. In particular, there are declaration date, the ex-dividend date, the holder of record date or known as record date, and also payment date are relevant. So on this presentation, I'm going to discuss about the dividend payment chronology and discuss what happened on each date. The first one is declaration date. So when a company pays a dividend, there are a number of dates that are important. And the first important date is declaration date. This is the date when the company decides to pay a dividend. More formally, it is the date on which the board of directors approves payment of a dividend. So on the date, the company also specifies the dividend amount, the date the shareholders must own the stock, for example, like the record date, to see the art below, and the date the dividend will actually be paid to the shareholders that are eligible or known as the payment date. And for the second one, there are ex-dividend date. The ex-dividend date is the first day on which a new purchaser of stock will not be entitled to the dividend because they already transacted. Typically, the stock price drops by the amount of the dividend on the ex-dividend date. This ex-dividend date is 1 or 2 business days before the record date. For example, if you buy a stock before this day, you can get a dividend. If you buy a stock on or after this day, then the prior owner gets dividend. So this date is determined by the exchange on which the shares trade. And the third one is holder of record date. The third one, there is the holder of record date, or short for record date. And this is the date on which all owners of the stock will receive dividend payment. Again, this is because settlement typically takes 1 or 2 days. So it is only that we can say with certainty who holds the stock company. So unlike the ex-dividend date, this is determined by the company. And the last one is payment date. This payment date is the date on which a firm actually mails dividend checks. Nowadays, this is done electronically by wire transfer, but in the past, sometimes people done it by mailing checks. So this is the payment. This is a date when the payment is actually made to the shareholders. And the date is determined also when the dividend payment is made, and it could be on any day, including weekends, weekdays, or even on holidays. So let's consider an example for the dividend payment date. On the ex-dividend date, the price will fall by the amount of the dividend in the absence of any other news event. Thus, if the stock closed, example, at 50 the previous day and the dividend is 5, then we can expect to see a price of 45 at the opening on the ex-dividend date. So just like what I said before, it can be in any day. Okay, so now we have discussed the dividend payment chronology, and maybe you can see it on the screen. There are the declaration date on, for example, 15th of January, and there are the ex date on the February 20, and the holder of record date on February 22, and the payment date. Maybe you are considering why is there are 2 business days between the ex date and the holder of record date. So the time between the other pertinent dates, it's determined by each company and can be very substantially, except for the time between the ex date and the holder of record date, which is in 2 business days. Thank you.
Hello everyone, my name is Akbar Shariza, and I'm going to explain more about the ex-dividend date. To determine whether you should get a dividend, you need to look at 2 important dates. They are the record date or the date of record, and ex-dividend date or the ex-date. When a company declares a dividend, it sets a record date when you must be on the company's books as a shareholder to receive the dividend. Companies also use this date to determine who is sent to proxy statements, financial reports, and other information. Once the company sets the record date, the ex-dividend date that is set based on the stock exchange rules. The ex-dividend date is for stock usually set 1 business day before the record date. If you purchase the stock on its ex-dividend date or after, you will not receive the next dividend payment. Instead, the seller gets the dividend. If you purchase before the ex-dividend date, you get a dividend. And for the example here, and on September 8, 2017, company XYZ declares a dividend payable on October 3, 2017. Its shareholders, XYZ, also announced the shareholders of record on the company's books on or before September 18, 2017 are entitled to the dividend. The stock would then go ex-dividend 1 business day before the record date. In this example, the record date falls on a Monday. Excluding weekends and holidays, the ex-dividend is set 1 business day before the record date or the opening of the market, and in this case, on the preceding Friday. This means anyone who bought the stock on Friday or after will not get a dividend. At the same time, those who purchased before the ex-dividend date on Friday will receive the dividend. With a significant dividend, the price of a stock may fall by the amount of the ex-dividend date. If the dividend is 25% or more of the stock value, special rules apply to the determination of the ex-dividend date. In this case, the ex-dividend date will be deferred until 1 business day after the dividend is paid. In the above example, the ex-dividend date for a stock that's paying a dividend equal to 25% or more of its value. Sometimes a company pays a dividend in the form of stock rather than cash. The stock dividend may be additional shares in the company or in the subsidiary being spun off. The procedures for stock dividends may be different from cash dividends, and the ex-dividends date is set the first business day after the stock dividend is paid.
Next, we're going to talk about the subchapter 2, which is does dividend policy matter? So I'm going to talk about the relevance of dividend policy. The best way to explain this is with an illustration. In this illustration, we can see that Wharton is an all-equity firm that has existed for 10 years. The current financial manager will plan to dissolve the firm in 2 years. The total cash flow the firm will generate, including the proceeds from liquidation, will be 10,000 in each of the next 2 years. There are two ways to calculate this. The first one is current policy, which is the dividend set equal to cash flow. At the present time, dividend at each date are set equal to the cash flow of 10,000. There are 100 shares outstanding, so the dividend per share is 100. Assuming a 10% required return, the value of a share of stock today will be, as we can see, the formula is D1 divided by 1 plus R to the power of 1 plus D2 divided by 1 plus R to the power of 2. And if we put in the numbers, we can see that the result will be 173.55. So the firm as a whole is thus worth 100 times 173.55, which result in 70,355. The second policy is the alternative policy, which is initial dividend greater than cash flow. Another possible policy is for the firm to pay a dividend of 110 per share on the first date, which is a total dividend of 11,000. Because the cash flow is only 10,000, an extra 1,000 must somehow be raised. One way to do this is to issue 1,000 worth of bonds or stock at date 1. Assume that the stock is issued, the new stockholder will desire enough cash flow at the date 2, so they earn the required 10% return on their date 1 investment. So here's the calculation for alternative policy. So the new stockholder invests 1,000. They require 10% return, so they will demand 1,000 times 1.10, which is 1,100 of the date to cash flow, leaving only 8,900 to the old stockholders. The dividend to the old stockholder will be as follows. As you can see in the picture, the aggregate demand to all stockholder at date 1 will be 11,000 due to the new stockholder investment, and will be 8,900 due to the 10% required return. So this will put the dividend per share at 110 in date 1 and 89 in date 2. The present value of the dividend per share is therefore, we can use the same formula as before, 110 divided by 1.10 to the power of 1 plus 89 divided by 1.10 to the power of 2, which is 173.55. This is the same value we had before. So we can use both alternative policy or current policy because it leads to the same result.
Hello, it's me again, and I'm going to explain about the HOMAD dividend. So HOMAD dividend policy is the tailored dividend policy by individual investors who undo corporate dividend policy by reinvesting dividends or selling shares of stock. So HOMAD dividends refer to a form of investment income that investors generate from the sale of a percentage of their equity portfolio. And the investors fulfills his or her cash flow objectives by selling a portion of shares in their portfolio instead of waiting for the traditional dividends. And usually, if a shareholder needs some cash inflow, but it is not yet time for a dividend payout, they can sell part of the shares in their portfolio to generate the required cash inflow.
To summarize our discussion, we consider this following true or false test question. The first one is it true or false whether dividends are irrelevant, and the second one is it true or false whether dividend policy is irrelevant. To answer the previous questions, actually the first statement is false. And is it because the reason follows from common sense? Clearly, investors prefer higher dividends to lower dividends at any single date if the dividend level is held constant at every other date. And this for the second statement, it is true Why? Because dividend policy by itself cannot raise the dividend at one date while keeping it at the same at all other dates.